I often reminded my students that the hardest trade in the market is the one where you do nothing at all. I recall the copper campaigns of the early 1900s when a certain pool operator was quietly preparing a major advance. Day after day, the stock moved in a narrow corridor, deceiving the public into believing it was lifeless. Volume dried up to a whisper. The average trader grew restless, forcing trade simply to feel active. But I sat still. The tape showed me everything I needed to know: absorption on every minor dip, no real supply, and a deliberate hand supporting the line of least resistance. Weeks passed, and the crowd abandoned the issue entirely, right when the composite operator completed his accumulation. Then, with no warning, the stock vaulted upward on a surge of demand that seemed to appear out of thin air. It wasn't sudden. It was the logical outcome of quiet preparation. That advance paid handsomely, but only because the real work had been done long before the breakout, the work of waiting. The trader who cannot master inactivity will forever chase shadows, while the one who can sit still when the market requires it will always have the advantage. When I sat before the tape each morning, I never began by asking myself what I wished the market would do. I asked only what the market was actually doing. The law of supply and demand was always my first instrument, and it spoke plainly to anyone willing to observe without prejudice. Before a trader can decide whether to act or wait, he must strip his judgment of hope, fear, and impatience, for these emotions disguise themselves as signals. The market has no interest in our desires. It reveals its plans only through the deliberate operations of those who truly move it. The composite operator. And the tape is the only interpreter worth trusting. In my early campaigns, I learned that genuine demand shows itself through widening spreads accompanied by increasing volume on advances, while true supply makes its presence known through heavier offerings and a loss of upward progress. If these forces are not present, there is no reason to act, no matter how appealing a setup appears on the surface. There were times when a stock would rally enough to entice the public, yet I could see the lack of sponsorship behind the move. The upswings were feeble, the volume irregular, the progress easily checked. Many traders entered eagerly, believing activity alone was a sign of strength, but the tape informed me that the character of demand was insufficient to sustain a genuine uptrend. And so I waited, not out of caution, but out of obedience to the market's message. On other occasions, the action appeared dull and uneventful, but I noted subtle absorption, small waves of supply taken in by a steady, unseen hand. The public grew tired of waiting for excitement and wandered elsewhere, but I understood that the stock was undergoing the preliminary work necessary for a major campaign. In such periods, inactivity becomes the most profitable position on the board. A trader must never assume that a quiet market calls for impulsive intervention. One must ask, has supply demonstrated dominance, or is it merely being offered in small, manageable amounts which the CO eagerly absorbs? Has demand appeared with authority, or are the rallies simply mechanical responses lacking professional sponsorship? These questions cannot be answered by forecasting, only by continuous, disciplined observation. It is easy for the untrained eye to mistake noise for intent. I have seen traders buy breakouts without noticing that supply had increased just before the move, a sign that the advance was premature. Others sold sharp reactions without recognizing that supply was drying up and the selling was largely weak holders being shaken out. Both errors come from acting before understanding. The trader who begins each day by reading the balance of supply and demand will rarely be deceived by market theatrics. He will know when to step aside because neither force has shown itself decisively. He will know when to prepare, when to observe, and when to refrain from action, even if the crowd is rushing in. The market always reveals its true character through its own behavior, and the trader who anchors his decisions in that reality will find that waiting is not passive at all, but an integral part of the campaign itself. During the long years I spent studying the campaigns of the great operators, I came to understand that the most deceptive phase of any movement is the one in which the public believes nothing is happening at all. This is the period when the composite operator conducts his quietest and most important work, absorption. And it is during this time that the average trader loses both patience and capital. When a stock settles into a narrow range, drifts sideways, and shows no dramatic movement, the inexperienced trader assumes opportunity has vanished. But I learned to view these quiet pools of trading as the birthplace of the major advances to come. The very dullness that repels the crowd is what attracts the professional observer, provided he has the discipline to sit and watch without disturbing the delicate balance being formed. Absorption is not announced with fanfare. It appears in the tape as repeated small offerings taken in without effort, reactions that cannot extend themselves, and a steadiness in the face of attempts to press the stock lower. When I observed such behavior, I did not rush to buy, for the work was not yet complete. The CO does not accumulate in a single action. He does so through a series of campaigns, each designed to gather stock without attracting attention. My role was never to interfere with that process, but to study it, to understand the intention behind each seemingly minor fluctuation. This was where inactivity became a deliberate strategy, a position of strength rather than hesitation. I remember following a certain railroad issue that remained lifeless for weeks. The public lost interest entirely. The financial papers declared the stock dead money. Yet day after day, I recorded the same pattern: these small dips met with immediate support, volume contracting on reactions, an invisible floor beneath every attempt to shake it loose. While others turned to more exciting markets, I stayed with this one, not trading but observing. I knew from experience that when a large operator intends to conduct a major advance, he will first remove floating supply and absorb all weak holders. Only then will he permit the stock to reveal its true potential. To act before this work is complete is to risk becoming one of the weak holders oneself. In such periods, the tape requires a different kind of reading. One must examine the behavior of the stock not for what it does, but for what it refuses to do. If supply cannot push it down, that fact is more telling than any short-lived rally. If the stock rests quietly without breaking its support levels, the professional is present. If volume dries to almost nothing, the public has abandoned it, leaving the field clear for accumulation. These are not moments for action, they are moments for understanding. A trader who cannot endure these dull phases will never recognize the true turning points of a market. And so, in the periods when the composite operator absorbs and prepares, I sit with the same intentional stillness. I do not shake the tree to force fruit to fall. I wait until the operator has completed his groundwork, until supply has been quietly retired, and until the stock begins to show that unmistakable firmness which signals that the preparation phase is nearing its end. In those stretches of apparent inactivity lies the foundation of every successful campaign, and only the trader who respects that silent work is ever present when the true movement begins. In every major campaign I ever studied, the moment of truth never came when the stock broke out of its range or flashed a dramatic surge that caught the public's attention. It came instead in the quiet, easily overlooked tests that revealed whether the composite operator had truly completed his work. The public chases breakouts because they appear decisive, but professionals look for the removal of supply, and that is displayed only in the behavior of the stock when pressure is applied to it. A stock does not advance because it wants to, it advances because those who control it have prepared the path. The test, therefore, is not a mere price pattern, but a question. Is there anything left to stop the move? When I observed a spring, a secondary test, or a last point of support, I was not looking for excitement. I was studying the character of the reaction. If the market could dip without attracting meaningful supply, then the groundwork was finished and the stock was prepared for its natural movement upward. These tests take many forms, and each one teaches the same lesson. A spring may drop the stock below support only to see it immediately rescued by strong hands, the brief dip exhausting the last pockets of weak supply. A test may hold slightly above support, drifting down on the lightest volume, revealing that sellers have become scarce. An LPS may show itself as a shallow pullback after a sign of strength, proving that the stock now finds support on even the smallest retractions. I learned long ago that these subtle movements carry more weight than any wide, swinging rally. They are not accidents, they are the operator's final inspections, confirming that the stock is ready to be marked up without undue resistance. In one campaign involving a prominent industrial stock, I remember the public growing excited after a strong rally through the upper boundary of the trading range. The papers praised the stock's renewed vitality, and traders rushed in, believing they were witnessing the beginning of a major advance. Yet I refrained. The breakout was impressive in appearance, but uncertain in character. What I sought had not yet occurred, a test that would prove the absence of supply. The stock soon returned to the top of the range, and while the public interpreted this as disappointment, I saw precisely what I had been waiting for. The reaction was shallow, the volume dried up, and the offering was easily absorbed. It was a clear demonstration that those who wished to sell had either already done so or no longer had stock to offer. Only then did I regard the path as open. A proper test always carries with it an unmistakable tone. The decline is reluctant, the spread narrows, and the tape shows that every small offering is met with quiet demand. There is no urgency, no panic, no resistance, just a gentle probing of the market's readiness. When supply is absent, the stock behaves as if it has no desire to go lower. This is not optimism, it is the logic of the market revealing itself. The trader who understands this does not anticipate, he verifies. And when the test confirms that supply has been removed, he knows that the next movement will not depend on hope, but on the completed work of the composite operator. Once the test had shown me that supply was no longer capable of forcing the stock downward, I shifted my attention to the line of least resistance, for it is along this line that every genuine advance must travel. The public imagines that the breakout itself is the signal, but I learned over years of study that the breakout is merely the market's way of announcing what the composite operator has already prepared in silence. I never cared for buying dramatic surges. I cared for the moment when the market proved that the path upward had become the easiest direction for price to move. When a stock begins to rise with little effort, when reactions grow smaller and timid, when demand steps forward with a confidence that needs no flourish, these are the conditions under which the professional enters. He enters not because he desires action, but because the market has demonstrated that the time for action has arrived. I recall a certain campaign in a manufacturing stock that had been in accumulation for months. The range was narrow, dull, and seemingly purposeless, but I had watched each phase carefully: the absorption, the tests, the exhaustion of supply. When the stock finally produced its sign of strength, an advance on expanding volume, I did not rush to act, for the move itself was not the signal. My attention remained fixed on the character of the first reaction. If supply had truly been removed, the reaction would be shallow, hesitant, and short-lived. And indeed, the stock drifted back only slightly on almost imperceptible volume, finding support well above its prior levels. That was the market confirming the emergence of the line of least resistance. It was no longer difficult for the stock to rise. The groundwork was complete, and it required only a modest amount of demand to carry it forward. I entered my position not at the first moment of excitement, but at the moment of proof. A quiet LPS formed, a point where the stock refused to decline despite every opportunity. This refusal was more valuable to me than any newspaper praise or any analyst's enthusiasm. It was the market's own handwriting, declaring that the professional interests had finished their preparation and were ready to conduct the advance. From that point on, every rally progressed with a freedom that had been absent before, and every reaction encountered support. This is what I taught my students: wait for the market to make the next step effortless. When price moves upward with natural ease and downward only with reluctance, the trend has been born, and the operator has opened the gate. The line of least resistance is not guessed at, it is discovered. It appears only after the trader has done the quiet work of observation, after he has watched the tests, the diminishment of supply, the subtle strengthening of demand. To buy before this alignment is to force a trade. To buy after it is to follow the logic of the market. There is no courage required, only patience and the willingness to wait until the market itself points the way. The professional does not seek to outsmart the composite operator, he seeks to move with him, stepping into the current at the moment when the river begins to flow in earnest. Once I had taken my position along the line of least resistance, the real test of discipline began, for it is one thing to wait for the right moment to enter, and another thing entirely to sit through the campaign without allowing impatience to break the plan. The public believes that the trade ends at entry, but I found that the true profits were earned in the long stretches of quiet markup when nothing seemed to happen quickly enough. After the composite operator has cleared the path, he does not immediately reveal the full intention of his advance. He moves with deliberation, allowing the stock to rise in measured steps, checking the market's condition with controlled reactions, gathering momentum only when it suits the broader purpose of the campaign. The trader who expects immediate gratification will abandon his position the moment progress slows, surrendering his stock back to the very operator who engineered the advance. There were periods in my own campaigns when the stock moved upward in orderly fashion, only to rest for days or weeks, drifting sideways or pulling back slightly. The uninformed interpreted these pauses as signs of weakness or the end of the move, but to me they were indications of strength. A healthy markup never advances in a straight line. It must test the market's appetite as it rises, offering small amounts of stock to be sure demand is present. When these reactions were shallow and volume diminished, I understood that the movement was under expert control. My task was to remain still. Selling in these periods would have been an act of fear, not of judgment, and fear has no place in a campaign. One particular instance stands out. A steel stock I followed through a long accumulation phase finally broke into its advance. The first leg upward was impressive, but the second leg stalled midway, forming a tight consolidation just under a previous high. Traders grew nervous and sold, complaining that the move had run its course. Yet I noted the same signature I had seen countless times before: light volume on reactions, support appearing without fanfare, no evidence of significant supply. I held my position with the same quiet resolve I had used while waiting for the entry itself. Weeks later, the stock unfolded a far greater advance than the early traders had imagined, rewarding those who could remain inactive at the moment when the crowd demanded action. Inactivity after entry requires a different kind of strength than inactivity before it. Before entering, one waits for clarity. After entering, one waits for the campaign to mature. The mind rebels during these quiet phases, urging the trader to lock in gains before they evaporate, to anticipate reversals, to outthink the operator. But a campaign is not won by constant motion, it is won by alignment with the forces that drive the market. When the composite operator is conducting the advance, every unnecessary action risks sabotaging one's own position. The trader must let the markup do its work. intervening only when the market's character changes, not when emotion commands it. In this way, patience becomes not merely a virtue, but a strategic necessity, the same quiet force that secures the greatest profits in every well-executed campaign. A trader who follows the market through each phase, reading supply and demand, respecting the silent work of absorption, waiting for true tests, entering only when the line of least resistance emerges, and then remaining still as the campaign unfolds, discovers that success is built not on constant action, but on disciplined obedience to the market's own logic. In the end, mastery lies in the ability to wait before the move, wait for confirmation, and wait through the advance itself, aligning one's actions with the quiet intentions of the composite operator rather than the impulses of the crowd.